Hello, judges. I'm Jain, a senior at Georgia State University.
My name is Landon Meyer. I'm also a senior at Georgia State University studying finance.
I'm Sanusi, a senior studying finance like my two friends here. We're grateful for the opportunity to participate in this case competition, and we'd like to thank the judges for taking the time to review our valuation of North Star Casting Company.
Throughout this presentation, we're initially going to look at North Star overview, as well as we're going to delve into three different valuation approaches that we'll discuss, and at the end, provide a reconciliation of value using the three approaches. So when taking a look at the company overview, North Star Company is primarily a full service provider of aluminum and magnesium die castings located in the Northeast. And the company has provided a lot of die casting solutions for various industries such as auto, medical, defense for over 100 years. And some of the products and services they offer include transmission components, metal heat sinks, portable medical monitors, and services include die casting, tooling designs, and assembly and finishing. Some recent developments for the company is provided in the case George Hardman, previously CEO and current chairman of the company. He was also the 100% owner of the company. He recently sold 51% of his stake to the company's ESOP, retaining him with 49% of the company. And some leadership changes include Greg Smith assuming the position of CEO after Hardman moved to the role of chairman. And towards the bottom right here, we can look at a graph showcasing the top 10 customers of North Star. Despite them having over 70 customers in total, their top 10 customers seem to primarily dominate the majority of their total sales. And since auto is the majority of their sales as a company, North Star has implemented some tactics to try and mitigate industry and customer concentration. Some things they've done is, for example, minimize their concentration in the auto industry by capping their revenue for the auto segment at 50%, as well as individual customer concentration at 20%. And recently, this has been proved to be successful. For example, in the pandemic, where the auto industry segment declined significantly due to cyclical nature, their decline in revenue was actually offset by gains from their medical customers due to the increased demand for things like ventilators. And some details for their geography. The company has 3 facilities located in Illinois, Ohio, and Indiana. In Illinois, their headquarters are located in Chicago, where this facility focuses on aluminum die casting primarily, as well as machining and finishing. And all in all their 3 facilities have a total area of 184,000 square footage. And secondly, their Ohio facility, which is in Cleveland, is the company's newest facility, opened in 2000. And this facility is primarily focused on moving towards lightweight magnesium die castings. The company identifies this as a potential growth opportunity for them, and their plan is to move this facility to 100% magnesium. And lastly, their Indiana facility was established in 1989, and this houses fully automated die cast cells. And all 3 of their facilities are certified with high quality supply chain management, which is showcasing their ability to manage the supply chain, whether it's reducing waste or finding continuous improvements in the process.
Look at the current structure of ownership as well as the management team. We see the top here, the breakdown of shares between George Hardman and the ESOP. You see the ESOP has 51%, as we discussed before. On December 13th, that was the day of 2021 that George Hardman transferred the shares into the ESOP, and you can see the current share price at the bottom here. As far as the management team, as we can see, there was a big change in 2021 with the CEO, chairman, and president all being promoted or chosen during that time. A lot of them have been here a long time. As we can see, Ryan Anderson started in 1977, as well as their board members. There are 2 board members who are from outside companies, but they both look at other aluminum die casting companies and are very helpful kind of to counteract a lot of the insiders that are also on the board.
Looking at a high level, some of the competitive advantages and the growth drivers for the company, they have a long-standing reputation within the industry. They've been around for over 100 years, and they formed very deep relationship with their customer bases. They also specialize in magnesium die casting, which has also separated them from much of their competition. And the fact that they have an employee-based ownership program, it creates positive alignment between the actual workers and the ownership team because they're both invested in the entire company together. Management, as EK pointed out, has also capped any sales to one customer, such as automotives, to 50%, meaning that they won't actually run the risk of any one industry turning at a macroeconomic level and as a result affecting their entire business. You look at some of the growth drivers, that are going to help push their business going forward into the future. There's fundamental healthcare customer basis is expanding. There are opportunities to gain market share as two of their competitors have bankrupted in 2020, and it's already a very niche space. So that allows them to go ahead and steal more customers. They also have increased quoting activities from some of the leadership changes, as Landon pointed out earlier, such as Brian Anderson being promoted to higher leadership.
When taking a look at North Star Casting Company's current financial ratios, as well as some of its projections for the projection period, it showcases a steady growth rate of profitability, which demonstrates a pretty stable trend over a longer period. And this steady profitability is really crucial for the company, as management has now scaled their operational efficiencies to actually now focus on sales growth to drive future profitability and revenue growth. And when looking at their liquidity has been improving over the recent years, such as the current and quick ratio, which indicates better financial stability, along with greater ability to pay off any short-term liabilities or obligations. And when looking at their leverage overall, specifically their debt to equity, which has been decreasing, as well as their TIE, which has been increasing, both of these are positive signs, as it indicates stronger earnings quality and conservative strategy that focuses not just on short-term, but also longer-term growth, and also stronger solvency state. And for the projection period, management expects sales to grow at a CAGR of 9% per year, contrary to recent decline. And they're banking on the fact that they will continue to have recurring revenue from their existing customers, but also expand to newer markets, specifically with like their magnesium die casting. And gross profit margin is expected to stay consistent at 14%, which is also highlights their consistent track record of maintaining profitability. And lastly, EBITDA is expected to increase at around a 12% CAGR year over year, or each year, driven by increased profitability and operational efficiencies.
Utilizing the BV database, we're actually able to find some good data when it comes to economic forecasts as far as how we see the industry changing, taking into account the public sector, but also the private markets as well. One of the things that we've noticed and we touched on earlier was that their medical customer base is expanding, and hospital PMI has increased over the past 12 months, and that's expected to continue going into the next year. Some important economic indicators that are trending in their favor are LEI, which has been down for 6 straight quarters, which has sort of compressed some of the sales and purchases that we've seen just across the entire market, especially for small businesses, and that's expected to correct going into 2025. Prices of raw materials have also been increased as well with inflation, which has also affected, pressures on production and new orders that are coming in. Overall, manufacturing PMI has been up, hospital PMI has been up, and with labor force participation being steady, we believe that going forward, they're going to be able to improve their operating profit margins and also widen their customer bases.
Now we're going to delve into first of 3 valuation approaches that we will be discussing, starting with the asset approach. So when looking at the asset-based approach for North Star Company, we did take a lot of considerations in mind, such as making any balance sheet adjustments, whether it was trying to value assets at fair market value, or even making some adjustments on the balance sheet itself, such as accounting for any aging of accounts receivable, the true market value of inventories, etc. But these were also some of our limitations in that we were not provided, for example, with like an appraiser that would actually value our inventory. And so with these limitations in mind, we just went ahead with the simple approach of valuing their assets at book value, which is just our total assets less total liabilities. And that brings us to a net asset value at book of around 9 million. And since this approach does rely just on book value, rather than actually taking into account what the market would pay for North Star's assets, we're going to weigh this approach significantly lower when we reconcile our value with all 3 approaches in mind.
EK just touched on some of the limitations that were associated with using an asset-based approach, and we incurred the same thing when we're actually coming up with a market approach. Specifically, formulating a checklist, just because, the amount of information that we had, pertaining to manufacturing, specifically in the die casting sphere, was limited. Private company data is already really hard to find. And then using the deal stats database, there was limited financials we could also reference for each transaction. And as far as like live companies that we could actually reference that are currently operating, we also weren't really able to rely heavily on that data as well. So we really had to stick towards transactions, which spread over the course of 2 decades, and also were different in scale compared to our company. We also weren't able to confirm the accounting standards of the financial data provided, which, provides another, a couple questions and volatility to some of the results that we gathered. And then there were also some incomplete financials of some of the transactions that occurred, in the 90s and in the early 2000s. And just fundamentally, there were only a certain amount of transactions that we could actually reference. There were less than 10 transactions for us to reference. So we decided to be careful in our selections and focus on the ones that really applied to our company because we were specialized in die casting. We decided to go ahead and pull together 4 different, comparison. If we look at, Colonial Guild and their transaction, they were scaled, almost about accurate to our, company as far as size. But if we look at the more recent transactions, they also have similar financial structures at a high level, with the percentage of cost of goods sold and gross profit margins being close to identical with ours. So we also wanted to take those into account. We decided to use the MVIC as a way of standardizing to create weights for the multiples that we were going to touch on a little bit later. Though those transactions are most recent, they don't really capture the size, so it was important for us to use the Colonial Guild transaction, even though it was significantly larger than the others. So we decided to use a size-weighted method in order to come to different multiples that we're going to reference a little later. So after we used after we weighted, each of our multiples based on the MVIC, we then decided to use an equal weighting method once we were able to come to an indicated sale value for our MVIC over net sales, gross profit, EBITDA, and EBIT multiples. So after we did that, we were able to come to 20% breakdown for each using that equal weighted approach. And then from there, we were able to come to a total weighted value of $37 million. And 51% of the firm value based on the ownership stake of ESOP would mean that the valuation would come out to $19 million. And, in using this, we made sure to reference Northstar's 2024 financials in combination with the multiples that we gathered from the market in order to come down to our valuations.
So you've heard the first 2 approaches. Now we're going to look at the income-based approach and using cash flows to value Northstar. Start with our assumptions for the weighted average cost of capital. For cost of debt, we use the total interest expense over the total debt for 2024. This is accurate because different tranches of debt cost a different amount. And by using the total debt and total interest expense, we're able to account for the different tranches of debt and their different costs. Moving into cost of equity, the risk-free rate is a 20-year maturity as of October 25th, which is a value of 4.58%. For the equity risk premium, we use the S&P and T-bond average return of 13%. For the beta, we use a motor and industry beta for metals and mining of 0.96. We did read over this based on the company's current debt to equity ratio. The size premium we found on the PBV database for smaller companies was 4.26%, and we applied a company-specific risk premium of 5%. This leads to a cost of equity of 28.27%. For the target capitalization structure, we took the current debt to equity ratio, and we then used an exit analysis on that to see what the final ratio would be, and then we iterated those 2 numbers, and we arrived at 27% debt and around 73% equity. For the tax rate, we assume the current corporate tax rate of 21%. This gives a weighted average cost of capital of 21.65%. Moving into some financial metrics, for revenue growth, we did 3 different cases. Upside case, falling in line with management projections. Base case, we're discounting revenue by 2.5%, and downside case, we're discounting upside revenue by 5%. The rest of the metrics, we usually just held in line as a percent of revenue. Depreciation is a percent of net fixed assets. This is because it's an asset-driven expense. We did look at different expenses and if they varied as a percent of revenue year over year. And we found that there was less than 1% variance in the account. So we just decided to stick with what made the most sense. And it would be a very small difference if we were to forecast every account. Moving on to the upside case. So we use a perpetual growth rate of 3% for the terminal value approach, and for the exit multiple approach, we use the 5.3x multiple. We believe 3% is just kind of GDP growth. It's kind of inflationary. It's going to be consistent over a long period of time. And the exit multiple was the median found on the BV database. So looking at the upside case, we're going to have the next 5 years cash flow of $19 million, which gives us a 51% value based on terminal value of 18.7%. And then using exit multiple is going to be around 32 million. Moving on to the base case, once again here we decreased revenue by 2.5%. We saw a slight reduction in the terminal value approach to 15.8 million, and then also a slight decrease from the exit multiple approach to 29.8 million. Moving on to the downside case approach, this is our most conservative case. Here we see the 51% value of terminal value being 14.8 million, and then the exit multiple resulting in 27.7 million. And so here we weighted all of our approaches. So first of all, with the cases, we believe that the base cases we're most confident in. We just kind of measure projection a little bit. We do think that management is usually the most positive about their company. And the downside case, we discounted it more. I think the base case makes the most sense just based on, it's lower discount, but it's not unrealistic from the regional projections. And then as far as rating terminal value versus exit multiple, we have a stronger confidence in terminal value because in the exit multiple, that exit valuation makes up a large percent, sometimes 60 to 70% of the final valuation. And we think that that's a little unrealistic. We rather use terminal value because it makes up about 50-50 of the terminal value and the current sum of cash flows. And when we weight these out, we arrive at a firm valuation. This is the 51% of the ESOP is going to be 19.3 million.
So now for our final recommendation, where we take into account all of the three previous valuation approaches we just analyzed, we came to the conclusion that the asset approach was not an accurate representation of the indication of value for North Star. And that's primarily because, as previously discussed, with some of the limitations we had in evaluating that approach, we disregarded it completely as it's not a fair market representation of North Star's assets. So we evaluated this company using just the income-based approach and market-based approach, and we weighted the income-based approach at 70%. We did weigh it slightly higher, since it's based on actual future expected cash flows rather than relative market valuation. And after taking these two approaches in consideration, it came down to a final total valuation of the firm of around 32 million, and valuing 51% of that gave us a valuation of around 19.3 million.
Thank you for taking the time to listen to our valuation proposal. We enjoyed participating in this case competition, and we look forward to hearing your feedback in the coming weeks. Thank you for your time, and this was our presentation.